If you're a regular viewer of the channel, you know I usually recommend index funds and ETFs in my videos. But I know some of you like to pick some individual stocks, or at least mix a few into your portfolio once in a while. So how do you know if a stock is undervalued, fairly priced, or a total ripoff? I recently did a video breaking down everything you should know about PE ratios, but those should not be used in a vacuum. If you have not checked that video out yet, I'll link it in a description below. One major thing PE ratios overlook is the growth potential of a company. That's where the PEG ratio comes in. It takes the PE ratio and factors in the company's growth rate, giving you a much clearer picture of whether the stock is truly undervalued or just overhyped. Just like the PE ratio, the PEG ratio has its own limitations and pitfalls though. In this video, I'll break down the PEG ratio, what it is, how to use it, and what to watch out for. The PEG ratio is the price to earnings to growth ratio. Essentially, it takes into account not just how a company is doing right now, but how it's expected to perform in the future, offering a more forward-looking perspective than the standard PE ratio. Mario Farina first developed the PEG ratio in 1969 and published it in his book, A Beginner's Guide to Successful Investing in the Stock Market. But it was Peter Lynch who really popularized this metric. Peter Lynch was the former manager of the Fidelity Magellan Fund, whose impressive performance made him a legend in the investing world. The PEG ratio adds some context to the PE ratio by factoring in a company's projected earnings growth. PE ratios can be helpful in determining how expensive a stock is in relationship to its current earnings, but they don't necessarily reflect future potential. Take, for example, tech startups. Often their current earnings are very modest, but the market places a high expectation on their future growth. So their PE ratios can seem sky high, making them look expensive. But the PEG ratio shows if the stock price is justified by future growth. To calculate the PEG ratio, you divide the PE ratio by the company's projected earnings growth rate over a set period of time, usually 5 years. So you start with the PE ratio, which you can easily find on any site like Yahoo Finance. And then once you have the PE ratio, you divide that by the projected earnings per share growth rate for a specific period. For example, if a company has a PE ratio of 20 and an expected growth rate of 10%, the PEG ratio would be 20 divided by 10 or 2. Now, one quick tip here. I need to mention something because it trips a lot of people up. Normally in math and finance, you would convert percentages to decimals before you would ever use them in a formula. But the PEG ratio, that's not the case. It actually is kind of an industry practice to just use the growth rate as a whole number. So if the earnings rate is 10%, you divide by 10, not 0.1. It's an easy mistake to make if you're trying to do the math correctly. So let me take a moment here to say I'd really appreciate it if you could hit the like button, maybe leave some comments below. It really does help the algorithm and supports the channel, and I really do try and respond to the comments. So thank you for that. Now, later in the video, I'm going to let you know where to find the PEG ratio for individual companies so you don't have to do the actual calculations yourself. But first, let's talk about how to use them, plus all the pros and cons that come with it. If a stock has a PEG ratio of 1, that suggests that it's fairly valued. Its price is in line with its expected growth. If the PEG ratio is less than 1, that usually is a good thing. It suggests a stock might be undervalued because its price is low compared to how fast it's expected to grow. Now, if the PEG ratio is greater than 1, it means the stock might be overvalued. You're paying more for the stock than its expected growth justifies. That doesn't automatically mean it's a bad investment, but it does mean you should take a closer look before jumping in. Now, let's take a look at a simple example. Let's say we have three companies, A, B, and C. They're all trading at the same stock price of $150 with earnings per share of $15. That gives each a price to earnings ratio or PE ratio of 10, meaning the market is willing to pay $10 for every $1 of earnings for each company. Now, let's factor in the expected EPS growth rate for each company. If Company A's expected growth rate is 10%, Company B's growth rate is 20%, and Company C's growth rate is 5%, we can calculate their PEG ratio by dividing the PE ratio by the growth rate. Company A has a PEG ratio of 1, Company B has a PEG ratio of 0.5, and Company C has a PEG ratio of 2. While there are other factors that still matter, the PEG ratio suggests that Company A is fairly valued. Company B may be a good deal for its growth potential, and Company C might be overpriced. If you only relied on the PE ratio, you might think that they all have a similar value. So this example shows the practical use of the PEG ratio. All right, now let's go over some pros and cons of using the PEG ratio. First, the advantages. You saw in the example that we just looked at, the PEG ratio factors in the future growth, giving you a more complete picture of a stock's valuation. It encourages investors to focus on a company's long-term potential rather than just the short-term earnings. Also, keep in mind that different sources use different growth periods. Some sites calculate PEG ratios using only 1 year of forward earnings growth, while others use 3 or maybe 5-year average. It's probably more common to see a 5-year projected earnings growth rate, since it helps smooth out the short-term fluctuations and provides a better or more clear long-term outlook. Now, the PEG ratio is most useful when evaluating high-growth companies. For example, if you're looking at a tech company with skyrocketing earnings, the PEG ratio helps you assess if the stock price is justified by the future growth. So it can help compare fast-growing companies. Faster-growing companies can have vastly different PEs, and the PEG ratio helps to better level the playing field. But that doesn't mean the PEG ratio is perfect. It has its faults too. And here are a few things to keep in mind. First, the PEG ratio is only as reliable as the growth projections it is based on, and those can be highly speculative. Future growth can change for all sorts of reasons, and it's common for management or analysts to overestimate or underestimate a company's future performance or growth, sometimes due to questionable motives also. It's also not ideal for all industries. In sectors like utilities, financials, and energy, the PEG ratio tends to be less reliable. These industries often have cyclical earnings, making growth projections harder to trust. The PEG ratio is particularly questionable when comparing high-growth companies to low-growth ones, or when comparing stocks with high PE ratios to those with low PE ratios. It's generally more useful for evaluating growth companies, those with earnings projected to rise much faster than the market. Another thing people often overlook is that not all growth is equal, and it's not always easy to predict. A company might aggressively invest to expand, but that doesn't necessarily mean that those investments will create real value for shareholders. If you're wanting to find the PEG ratio for a company, there are some free places you can usually find them, like Morningstar and Yahoo Finance. At Yahoo Finance, just pull up a company and look under Statistics. At Morningstar, look under Valuation of a company. If you have an account at a major discount broker like Schwab or Fidelity, the PEG ratio should be pretty easily fine there also. So most people like to compare PE ratios, but if an investor focused on the PE ratio, they may have avoided some of the best performing stocks over the past decade. Some of the technology companies have had very high PE ratios relative to the overall market, but those stocks have been the primary driver of most of the gains in the stock market. Pairing the PE ratio with the PEG ratio helps to have a better understanding of valuations. But even then, relying on it without considering other factors can lead to mistakes. If picking individual companies, always consider the bigger picture when making investment decisions. So I do hope you hit the like button, subscribe, leave some comments below, and thank you for watching.